So I had a question on the XABCD, the market geometry, from one of the chat room members, and I thought maybe I'd grab some time to go over it and see what we can come up with. So let me just do some work here on this chart here a little bit. Set the dates back a little bit, maybe even 3 years. Okay, we could look into the past and you could see different forms of market geometry as they have formed. Okay, sorry about that. And what we're going to do is just start from a point and go forward. So it's always you're looking for X and then A, B, C, D. That's one way to look at it. Then you can have also where you have an Elliott wave pattern where the market goes from 0 to 1, then comes to a 2, then goes to a 3, and goes to a 4, goes to a 5, and then the correction would be A, B, C. A, B, C, which this is supposed to go back higher. So that's the typical sequence of an Elliott wave structure, but you also have this XABCD. Now, within this Elliott wave structure, we could just look at here and we could draw in an X, an A, a B, a C, and a D. So we're always looking for A, B, C, D. We're either looking for it like this, A, B, C, D, and this could have been your X, or we're looking for it A, B, C, D. So there's different forms of looking at it. So if we were to just to look at this Elliott wave structure right here, we can actually see this happening in this structure right here if we would have an X, an A, a B, a C, a D. Okay, we're going to identify that again. So we're looking at, first things first is you have your pole, and you have your retracement, you have a push to a lower high, and then another swing down. If we look at this in a harmonic manner, we would draw in this type of pattern, and it would have your X, your A, your B, your C, your D. And what does this mean? Well, from X to A, you're looking for a retracement down to D. From B to C, so from X to A equal D, and then from B to C equal D, and then A to B equals C to D. So we're looking at a measurement from B to C with the percentage down to the downside, and then from A to B, we're looking at C to D. So we start to put all these percentages together, and we're looking for where we have what we call commonality or a cluster of an area where the market can be defined, where we would say, okay, there's resistance or support in this particular area, and this is the area you want to work with. So let's do some drawing Fibonacci. So we're going to take our initial Fibonacci from low to high. And I'm going to take out 612, all these other ones, and leave in 38 to 50%. Then I'm going to go from B to C. I'm going to take out the 100 to 0. Going to change the color here a little bit. And I'm going to only leave in the important ones. Oops. And then we're going to look at the distance from A to B for a C to D relationship. So once again, I'm going to take out all the little swings that don't mean as much, that don't overlap. I'm going to put them in there. So essentially what we have right now, and let me just fix this. There we go. So we notice that this area right here, that there's cluster. Oops, let me put that back. We notice in this area right here that there's a cluster of price bars in that zone, horizontal levels also. So you can see price coming down into here, but what do we see? This whole zone is a cluster of support areas. Okay, so we have this whole area ends up being a floor, so to say. So when you're looking at the market, you're taking your low, all right, and you're identifying a spot where support can come in. Now, this could be considered also a corrective wave, but if we look at it in a harmonic fashion, you have your X, your A, your B, your C, your D, all tying into one area, which should set up your trade entry, and now you just have to define where your risk is going to be. So let's just say you bought at 2,700, and where would your risk want to be? You'd probably put your risk down here somewhere. So 25. So you'd have to risk a couple of $100 down there. Actually, this is a lot more. So you would go from 1.27 to 1.25 would be your risk. All right. So that's how you define your entries and exits, or entries and your risk points when looking at the markets. Now, does that mean you have to take a whole swing up? If you have only one position, you take what you can get. If you're just looking to just grab some money. But what's good is, and what I like about it, and what I've been doing with the IML, what we've been doing with IML is I'm taking these areas and I know I'm defining a wider risk. So by defining a wider risk, well, not that wide, defining a wider risk, I know I could find a spot where the market's going to hold. It may take time. It'll turn up, and I can kick them back out because we're using one position. Sometimes I'll put two, but I'm putting up to a couple of positions. So I'm also kind of hedging when we do our work, like we did last night. We did NZD USD, NZD JPY, and EUR JPY. Yeah, the daily buys. We also had some news coming out today. We have the FOMC. So I was like, you know what? Let's just take a trade that goes into London, and when they pop them up, kick them out. But for those of you looking for these bigger swings, it doesn't really matter. You can. This is a daily chart. You can do this on an hourly chart. So as long as you're defining these waves, these waves, you're always looking for D. So remember before, that can be one wave. Now here's the thing. If A to B is equal to C to D, then why is C to D larger than A to B? Well, understand that when you have your fib, it goes from 0 to 100. Well, it's not really fib. It's called phi. Then you have your 113 extension, 113, 127, 141 is not really used so much, 162, your 200, 225, and so on. So even though this may be a 1272, as you can see here, it's still within the context of an A to B, C to D relationship. All right, it's still in context. Doesn't mean that because this leg was longer that it invalidates this, because you're now tying it into other things, retracements, other levels. So you're looking at commonality. If you were looking just at only this and this, sure. When it surpasses that, then that's not a good thing. All right. But when you're looking at a cluster of price bars, you want to make sure all the mathematics line up and what they call market geometry. Market geometry. So let's continue along our way, along our path here. And I'm sure you guys could see the next one. If not, we're going to draw it out for you. So you want to kind of train your brain to always see these waves. X. Hold on a second. Let me just fix this. Had my microphone on earlier, huh? Here's X to A to B, B to C, C to D. And you're drawing these levels like that. You're looking at, this is really what you're looking at. Retracements from these zones. So you're looking at X, A, and then A, X, A, B, okay? And then B to C, and then C to D. So it really looks like that, but we like to color in, make this thicker here. We also look at the AC relationship too. And what you're defining again is you're looking at where X is down to A, up to B, where X is down to A, up to D, A to B equals C to D, and then B to C, mathematics right up to D. And you're looking at commonality on how this all ties together, a zone to define an entry, and then also a risk point. So let's start with the initial. You always want to take the A, X to A, all right? And you'll see sometimes it'll pass that, and if it does, you could put in a 7-1, a 707 retracement, what we call 7-1. So you could put in your 707 retracement. Let me just show you also something here. Okay. Hold on one second. I had a little bit of water here. Okay. So your next, the next thing we want to look at is your B to C, and you're going to start to see stuff just appear on the chart, and it's going to start to make sense. Is now you're seeing the 141 extension have the 71% retracement have a 141 extension, is because the 7-1 is tied into a square. So it's not tied into what they call a fib or a phi. All right, it's a whole nother number that we use here. Okay, I'm just trying to get that to, okay, there it goes. All right, so then we want to draw in your A to B. Now, a lot of people actually draw the A to B with the extension up, and that's okay too. Sometimes I do it, sometimes I don't. But let's just draw it in just for grins, and we'll see how that starts to look. All right. You see how that can look. Let me get rid of this 1272 and 100. But we're also going to take this and I'm going to place it right here. So let's see which ones match to start. So we see the 1272 and the 141 extension work. Okay, so what do we have? Let's draw it in. We have an X, we have an A, we have a B, we have X, A, B, C, and we have a D. All right, and what do we have up here is we have this whole cluster like that. So this is something that you can actually, if you were to trade it, you'd put your stop a bit higher up, or you could put it up here, but you want it away from all this noise. And this would be a very, very heavy area, a big area to watch for resistance, like that. All right, so at least you're identifying. So whether you're shorting them here, shorting them here, shorting them there, it depends. But this is a big resistance area up to this zone right here. And once again, you're drawing in your patterns. If I can get my chart to work. X. Okay, and that's how I identify the different patterns that we work with. I know we had quite a few of them. I know this, and like I said, whether you stay with them or not, at least in one respect, we're finding them, but we're also limited to our positions also, and I'd rather just start grabbing the money and getting consistent with you guys. So what we're seeing down here was that pattern, but this came from, it looked like this. So we're going to redo this. Watch. Okay. So look at it again. You have your X to A to B, B to C, C to D, and then up. The difference between this is one we did recently, is your X, A, B, C, D. Now, in this case, this is where your C goes above A and your D comes below B. And again, you're looking at clusters. It's all the same in terms of your clusters, how you look at it. All right. So I hope this answered some of your questions, and we can do another little class in the future. But I thought maybe just to share some thoughts and ideas with you.